Hey everyone, my name's Andy. I'm with the Finding Value Finance channel. Today I've got Scott with us. He's also from the Sow and Reap Capital channel. And then I've got today a new guest, Mark McGuire. He said he hits home runs out of the park on Twitter. I'm just messing. So the reason we wanted to bring Mark on is he's got a very different viewpoint than Scott and I, and he always posts on Twitter pretty actively, and especially points it at Scott and I. So we read a lot of his tweets, and he holds a lot different viewpoint on the markets than say maybe both of us. And it's a little bit more bearish in the short term. He thinks that we're going to have a larger pullback, maybe a recession, something on the lines of that. And Scott and I kind of have a little bit different viewpoint of maybe that the recession may be a little bit further into the future than maybe say Mark. So maybe we can start the discussion off with maybe your viewpoint, Mark, on what you think the market might do here in the short term, like your time frame, if it's going to pull back, like what kind of your position is on the markets.
Okay. Well, yeah. Thanks, Andy, for having me on your show. Awesome show, by the way. Love it.
Thank you.
Yeah. So short term, I have next 3 to 6 months, very, very bearish. That's if the Feds does what they say. They say 50 basis points in June. I've heard that they're doing 50 basis points in July, but they're going to start taking off their balance sheet, and they're doing 30 billion a month starting. That's way more aggressive than they did last time. When they did it last time, they went 10 billion a month, and then they ramped it up to 30. So they, try to even, get it slow, and then ramp it up. So they're getting very aggressive. I don't think that they're going to get that far, and they're going to have to reverse course, because I think that this is a Ponzi scheme. But I see it 1.5 to 2.5%, and then things are going to start breaking. And when that stuff starts breaking, it's disinflation, possibility of barely deflation, and then they're going to have to reverse course. And then, Andy, 100,000%, Scott, game on. Uranium, gold, metals, you name it, any commodities will go through the roof, in my opinion, because everyone will know, everyone will know the inflection point of, wait a second, the Fed can't do anything about this inflation. And then we just go. So
let me like just go back and kind of reiterate some of the stuff you said. 1.5% is the federal funds rate. You don't think they're going to be able to go above 1.5% of the federal funds rate? Is that what you meant by 1.5%?
Yeah, Fed funds rate 1.5 to 2% at the most. And the reason I say that is because every time we have a crisis, they get to a lower height every single crisis. The last time they got to 2.4, and then all of a sudden they had to reverse course. So from 2018 till now, there's more leverage and debt on the system. So in turn, I don't believe that they're going to get to 1.5 to 2, and things are going to start breaking. But if they, and now I believe you're right, if they don't do what they say they're going to do, and they just start backing off of everything, then it'll be a while.
And then you also said disinflation or possible deflation. What do you mean? So when you're saying that the inflation is coming from the Federal Reserve, and that's the money coming into the system, so you're saying that them pulling back on that money is going to cause or lead to disinflation or possibly a reverse course of inflation. Is that what you're meaning by them not putting as much money into the system? That's where the inflation is coming from?
Yeah. So I believe, my opinion is, they waited way too long. They're behind the curve. They should have started increasing the Fed fund rates a year ago when we were in the growth part of the cycle. Well, we're in the slowing growth now. So as they increase those rates, we'll have, let's say, they say 8% or 7.5% inflation. Andy, it's way worse than that. But they're not gonna tell the truth, right? Because they want to inflate away the debt. But then in turn, if let's say it's 7.5, just to say, the coming months it'll go to 6 to 5 to 4 to 3, and then things will start breaking, and we might get it to 0 or negative inflation, and then all of a sudden, because things are breaking, they'll reverse everything. And Andy, my opinion, when they reverse everything, they're going to try to do what they did before, and it's not going to work. They'll have to intervene more than they did last time.
And when you say things are be breaking, is there any way that we could view or see these things breaking? Like, what are you monitoring, or what are you looking at when you mean by like things are breaking? Or you just think it's something deeper in the derivatives market, or like, what do you mean by breaking? And what are you
It's
monitoring?
it's in the credit derivatives market that something breaks, and probably if the Fed finds out about it, they're never going to tell anybody. But my gauge is the RRF. Soon as that starts depleting, that'll be my point where, because there's in the reverse repo facility, there's 1.5 trillion. When they start deploying that, that tells me that's their only band-aid on the system. So as something starts breaking, they start getting rid of that. When that starts reversing down to 400 billion, 300 billion, 200 billion, I'm going back in, because I don't believe that they're going to allow, after they have their buffer, to all of a sudden let that go without reversing course, and then quantitative easing and all that other stuff to make sure that they're back to doing what they were doing before.
And when you say recession and all these things, what are you using to gauge that by? Are you looking at the stock market? Are you looking at the bond market? What are you looking at to gauge the market and say, like, we have a problem or it's contracting? Is it job losses? Like, what metrics are you looking at to determine how bad the situation is?
Personal savings rates, they're the lowest there. And here's the scary stat. Personal savings rates are lower than they are pre-COVID. Okay. The difference, and it's like almost neck and neck, right? But the difference is we have way more inflation now than we did pre-COVID. So then that to me will eat away at people's pockets a lot quicker, because stuff isn't getting cheaper right like it was in pre-COVID. It's high now. That would be an example. But then the stock market, yeah, go ahead.
Well, I just want to understand your situation before you're like moving forward and giving like my opinions or whatever. You said that you're expecting a kind of like recession or a contraction with disinflation or possible deflation. Is there a scenario that you have where we could have a recession but have it be inflationary?
Not the way the system, if a lot of people had money in their pockets, yes. But you're seeing the saving, the people are starting to go, I wouldn't say broke, but people are loading up on credit cards right now.
That is true. Yep.
If the supply just plummeted compared to the demand, then you're going to get the inflationary part with the recession. You'll get the stagflation.
So when you say inflation and deflation, what's your definition of inflation and deflation, just so we're on the same page?
Inflation is an increase in the money supply.
Okay, so that's your definition.
Yeah, it's tied to goods. How many goods are in circulation?
So, because the way that I define inflation, deflation is the expansion of the money supply is inflation. Deflation is a contraction of the money supply. Consumer price index is a measurement that they try to use and manipulate to whatever well-being of that they want to use it for. And that is just the translation of money printing into basically commodities. And commodities are the thing that translates or shifts that money supply into the products themselves, the cost of the products. So I can give a spiel right here of kind of what happened leading up to this and what my opinion is real quick. And I don't know if you want to, we can debate back and forth the merits of it or not, if you want to.
Yeah.
Okay, so I'll just do a quick little thing here. So money has to be able to go into the system. The money has to reach the system. And what I mean by that is they won't consider it to be inflation until it reaches the consumer price index by their measurements. So that's money reaching the system. Now, the last cycle that we went through in the mid 2000s where we crashed in 2008, which was the cause of that was the housing market crashing. And it was a deflationary collapse because credit was destroyed when the housing market went down and all those loans went bad. So the loans went bad and it destroyed money in the system, that credit. Now, during that time frame, there's a couple of good things and bad things that happened. One, we cleared all of the bad stuff out of the system. I'm using this from Scott because I like it. We cleansed the system of the bad credit. So that's number one. Number two, they printed a bunch of money into the system, but it had no way of getting into the system through the home loans, I should say. We had a destruction of credits. I mean, there was some loaning going on, but it was very low. So it was a disinflation / deflation type period where money went into the system. They recapitalized the banks with all this stimulus money. And then all of that money got transferred over to bonds and stocks. And we could see that in the ratios. They transfer all that money over there, but there's no way to get the money into the system to create inflation. There was no demographic to really drive it. Now, what's coming up, I would say since about 2018, 19, somewhere in that range is where first kind of like we had this little hump in demographic. We're coming into a demographic in home buying years that's much larger. It's the millennials coming up, and it's a rate of change of demographic which is very steep, like the baby boomers coming into home buying years. So I think, and my opinion is that we are coming into an inflationary period because money is getting into the system through loaning of commercial banks against residential real estate. And that loaning is getting into the system. It's not contained in the banks and not contained into financial assets. It's actually reaching the people on the streets and reaching the consumer price index. It's getting basically in the system sloshing around. And what's going to happen is you're going to see a rotation of money, which is massive because they printed all that money from the last crisis, threw it all into stocks and bonds, and we're seeing that all unwind in front of us. That unwinding may pull and distort things in the market, like it may pull our market down with it as they are rotating a bunch of money. We might see the dollar get stronger. We may see weird things happening when that money starts to rotate, because they can't just go directly into a commodity from a bond. They have to rotate into something first, which is dollars or some currency or whatever it is. So they're rotating all this money and it's pushing, pulling, distorting the markets in certain ways in the short term. And then when that money goes to rotate over into commodities or precious metals or something else, you're going to see a massive CPI print number that continues to go up because that money is now being, quote, seen in the system through the consumer price index. So that money rotating, and which we're doing right now, it's rotating right now. The markets are starting to roll over because they're going to rotate this money out. And it's rotating because of inflation. It's rotating because of that inflation, because the demographics coming through, and they want and need to try to slow this thing down, but the demographics so large, again, this is my opinion, that it's not necessary, it may or may not necessarily work the way that they want it to because of the demographic. And in the 1970s, there was a large demographic that hit, it fell back down, and then there was another larger demographic. So it was like a double hump of the demographic. So in the mid 70s, it was the demographic that fell off and then came back versus say a deflation out of nowhere, so to speak. It was the demographic driving this whole thing. And I've got some data and charts there, but that's kind of the big picture view of how I view this whole thing. And that the demographic is driving inflation. It's going to drive higher interest rates. It's going to drive rotation of money into commodities over time. What do you agree or disagree, or what do you, remember, I don't have this completely right. It's just my opinion. What's your opinion on the short term and medium term, or this entire kind of thesis that I've got that I just laid out right there?
I agree with you after 2008 that the money didn't get into the full system because they did the quantitative easing, because in reality, the Fed doesn't print money. They don't. They reserve swap it. That's what they're doing, right? And then they're taking the debt off the banks and then saying, hey, you guys go out and loan more, right? To me, they're counterfeiting. But I agree with everything that you're saying. I just don't see the rotation. That's the only thing I think we disagree on. And
Okay.
what I believe you're seeing it in the markets right now, as in the stock market falls, uranium stocks get hit, commodities get hit, everything is deflated. They start tanking, right? To me, because they're flying to safety, they're probably going into cash. I don't believe they'll go from stocks right into commodities. You know what I'm saying? I say they will go into cash or they'll go into bonds. In disinflation to deflation, they'll go into bonds. And I don't like bonds either as much as you do, because because the inflation. But in a disinflation to a deflation, they'll go to the bond. They'll markets fall, disinflation, deflation. They go to the bonds, and then all of a sudden they go, when everything whipsaws back up, they go right into commodities.
So I'll ask this question back. If they're going to bonds, or if you think they're going to go to bonds, why are we seeing such a high increase of interest rate, meaning that everyone is selling bonds because the interest rate's going up? If they're running into bonds, we would see the interest rate fall, wouldn't we?
Totally agree. Because right now, future expectations coming are of inflation. The market's not thinking forward that we're having disinflation to deflation. When that turn starts, then they'll flight into bonds as everything starts disinflation and deflation.
So what you're saying is we're currently, like right now, currently we are seeing inflation, and that you think that sometime soon that the interest rates will pause and start to come back down as people buy more bonds. Is that a fair statement?
Exactly. As the June, July-ish, where they get to the 1.5 to 1.75 roughly on the Fed's funds rate, then that'll be the turning point, because that'll be when the things start breaking.
Okay.
In my opinion.
So I've got two questions for you, Mark. So first of all, aren't bonds usually leading, in that it's usually the bond investors that usually, make the move first? And when you talk about 1.5% to 1.75% in Fed funds rate, that's still like a year away. So why the short-term downward movement now?
Okay, so the second question, if the Fed, right now the Fed's at 75 basis points, right?
Yeah,
right?
I think so.
Okay, so if they say what they say they're going to do, they're at 1.75 in July, because they're going to increase it 50. They said 50 basis points in June, and then 50 in July. That's 1.75. So that's not a year from now. And and then what was your first question? Sorry.
So don't bond investors usually move first ahead of the markets?
Yes.
And so what Andy's been saying is basically the rates are going up, which means the bond investors running away from bonds right now. So yeah.
The bond market usually leads, but the bond market isn't always right. And I'll give you an example. In a year, the bond market's saying that in a year or two from now, we're going to have negative real interest rates.
Yeah.
Which I think.
Yeah.
Am I correct on that, Andy?
Yeah. So that's what I'm positioning for, is that outcome, because the bond market. So I'll just describe kind of what my thought is, and we can go back and forth there. I think that the banks have insider information, obviously, because they are the ones creating the loans and making the loans. If deflation was a problem, that means that credit will be destroyed, and the banks will know that credit will be destroyed. If the banks know that their own loans will be destroyed, they would position themselves into bonds, and we would see them positioning large amounts of money into the bond market. The problem that I have right now is I'm using the banks and what they're doing and how they're positioning to basically position where I'm at. So if I see the banks running away from bonds, which is an increasing yield, the 10-year yield I'm using specifically. So if the increase of 10-year yields going up, banks are positioning away from bonds. So, and remember, they know what their loans are doing. They know the performance of their loans. They know which ones are going to default, what's going to foreclose. And when you look at their movements, remember, they're leaving, I'll call it, they're leaving traces. They're leaving little crumbs of information everywhere with their money flows. I'm just watching what they're doing and what their money flows are doing. And then I'm making educated, not really guesses, but more like positioning off of how they're positioning because they've got all the information. So what that's kind of how I'm viewing it. Is that kind of how you're viewing it, or what, how are you viewing it in that way? Or are you trying to predict kind of that they may turn at some point?
I think that's a good point you make, but that to me would mean that these people have morals. And what I mean by that is, if we did that same concept in 2006, 2007, that same idea, what were the banks doing back then?
They were running into bonds because they thought a crash was coming in 2007.
No, but I'm saying that they're loaning out money to anybody and everybody to make money.
Yes, but they were also loading up on bonds, and your interest rate of the 10-year fell in 2007. You could see their movement of their money. So they knew that there was a problem, and they were positioning for it.
Okay, that's a good point. That's a good point then. That's a good point.
Yeah. So when I look at this, I say, okay, you can tie a couple of things together. I'll just screen show you something real quick. Maybe I'll pull up the 10-year yield too, because I don't know if I have the 10-year yield on this. If you look in 06, 07, 06, our inventories were going up the entire time, and in 07. We hit these critical levels of 8 to 10 months. Over 10 months is crash territory. That's where I'm like, it's done for. We hit the 10-month and started to reverse. But at this time in 07, we were already rocketing higher for a good year to 2 years. We had a 2-year increase of inventory. That's our heads up before a crisis came, at least from the housing market. So from the housing market, that crisis came, and we saw it in the inventory number. I said, there's something wrong here. You then turn to the bond market, the 10-year yield. And the 10-year yield, if I were to yank that up real quick, I didn't have that ready. Oops, trading. And we'll just look at
Andy, I can
TNX.
share it on the screen if you want.
Yeah, okay.
I've got it set up.
Go for it.
Right. Can you let me share my screen,
Yeah,
please?
I just got it.
All right, awesome. So this is what Andy's talking about. So before the 2008 financial crisis, bond investors were basically running into bonds, dumping the rates down. So this is a breakdown in rates, right? So what we don't see here is, and we saw that before the 2020 flash crash as well. So people were running into bonds, driving the rates down, right? Do you see that there? Yeah. What's happening right now is people are running away from bonds, which means they are running away from safety into risky assets. And what we've talked about here briefly is that you said money's not rotating into commodities, but what you see in the bigger names is they've been skyrocketing higher. So look at that. This is a chart of the ExxonMobil. And you see that across the biggest oil producers across the board, is that you're seeing money, big money, positioning themselves into commodities right now. So with uranium, yes, it went down, but how about if it was just a euro rebalance? Because last week was the euro rebalance. They had to sell a bunch of CCJ, so Chemical Corporation's shares. And what if it was just that and nothing more than that? So you've got Shell that's been going up as well. So it's looking strong, right? It's a fat green candle on a monthly chart. So I feel like it's almost like showing us that big institutional money is positioning themselves in energy sector right now, because they're running away from bonds. They need to find a place where they need to put money, and they're running into these big energy names, because obviously these are the only names that they can get into due to liquidity and so on. So that's what I feel like is happening right now. Sorry, did you want to comment on that at all, Mark?
Yeah, so to me, ExxonMobil and Shell, that's because oil prices are going up. What happens right before a recession? Oil prices top out and then they crash.
Today,
right?
But it takes time, right, Mark? It's not like an immediate thing. So let me just put this on a more.
If you look at the oil price, it's a gradual up, and then it just collapses within very, very quickly.
The one thing that you'll see, in my opinion, if I were to share, if you take an oil price and a 10-year yield, what you'll see is a divergence. You'll see the 10-year yields, people start loading up, and then oil price will do its last, like kind of peak movement higher.
Yep. That's
So
right.
that's what I use. I look to see how the banks are positioning in the bond market, and then you'll get a blow off top usually when they diverge. Sometimes when I see that. So if you look it down at the 10-year yield and you look at where things start to diverge, you'll see a divergence between oil prices and the 10-year yield, at where the yield starts to roll over and go down while the commodity prices
Yep, like
tend
that.
to stay moving. Yeah, just like that. Yep.
Yep, that's exactly what's happening. Yep. And then the oil prices does a blow off top. So we're not at a stage where US 10 years coming down and creating that divergence is what
Yeah.
Andy's trying to say. So what you see here is the bond is giving you a warning sign well beforehand that there's going to be some type of market downturn, right? So it's started coming down. So bond holders are pretty much selling off here.
Right.
So sorry, running into safety here. And then you see eventually a blow off top in the oil prices and a market downturn. So the bond investors know well before, which is why Andy and I look at it so closely, because we're looking to see whether the bond investors are running into safety. And right now they're not. They're running away from safety. They're dumping US 10-year.
Yeah, I agree with that.
Yeah. We're,
So another thing that I just want to, oh, sorry, did you want to make any other
go for it.
comments?
no, go for it.
Mark?
Go
Yeah,
for it.
no,
Scott.
no. Go ahead. Go ahead.
Okay, I just wanted to show you something else here as well. So this is the personal savings rate that you've been talking about. So I just want to compare it to recent history of where, you know, we saw a fall in personal savings rate and what happened to the markets, right? So we've got personal savings rate, which dropped. So note that we are still sitting well above the historical lows, right? The decade or 2-decade lows. So we're sitting well above it. We're still sitting at 6.2% in terms of savings rates. And what we see here is we see a drop in personal savings rate, yet markets hadn't had a blow off top yet. So there was no decline in markets because the personal savings rate went down. There was actually a little bit of a blow off top a couple of years later, which is what I'm kind of expecting. Another period where we saw a huge drop was in 2013 here. So we see a huge drop and then the markets run, right? For a long period of time. So from 2013 to 2020, that's like 7 years. And what's happening now? So here's the view. This is my view of the personal savings rate, right? So we haven't seen a negative personal savings rate. What this means is this is excess liquidity that the individuals have built up over time. This is money that they can deploy now, right? So this is a completely different view of it, because what you're saying is personal savings rate has come down. It's come crashing down. But what I'm saying is it's only just starting to normalize now. And all that excess, if you want to call this excess savings, right, for the last 2-3 years, this is all the money in your bank account that they can now deploy into the economy. Does that make sense?
Yeah. So Scott, where I'd push back on you is when you
Yeah.
if you go back to 2006 range,
Yeah.
it's a lower savings rate. But if you look at the totality, we did not see the inflation that we have right now since 1980. There was hardly any inflation back in 2004, 2005, that now it's just way, way higher. And that's what I'm saying is that number is going to fall dramatically because your wages aren't meeting the inflation rate. And that's going to kill that very quickly. That's my opinion.
Yep. No, I agree with you there. So I think first of all, two things need to happen. So, you know, the drop in the personal savings rate don't immediately cause a crash. Do you agree with that?
Agreed.
Okay, so that time frame. So where we disagree with you is in the timing. So I think we agree in many respects, but what we see over the next 2 years is almost a blow off top in commodities rather than a deflationary pressure. That's where we kind of disagree on. So the timing becomes a little bit important. So First of all, it doesn't cause an immediate crash. Second of all, I think this is extra money that they built up. So if you want to just draw like a shade in here, this is like extra cash that they built up in their savings account, ready to be deployed, right?
Where I would push back is, remember when you said that when the personal savings rate falls, you don't get an ultimate crash? To me, that depends on how high the rate of inflation is to the personal savings rate at the time. If you have massive inflation, and then if the inflation rate's just, I'm talking like Turkey or way high, you're going to get you're going to ultimately get a crash. If wages don't meet that, obviously wages go up in the inflation, but they don't, it's a lag time.
Yeah, that's right. So the key word there is ultimately, right? So how long do you think it will take until, you know, they deploy all the extra savings that they built up over the last 2 years?
But see, for me, I don't believe that graph there, so the huge spike up, that's from handing out all the checks to everybody. And then all of a sudden that dip down is everyone's locked at home. And all of a sudden they're just deploying all their stuff. Inflation ramps up. And then all of a sudden you get the decline. So everyone doesn't have that money now. And it makes it worse because as the stock market goes down, their wealth effect goes down.
So you don't believe in the savings numbers? Is that what you're saying?
No, I believe in the numbers. I just believe right now that it's at 6.2. That spike was when everyone had tons of money. But as that goes down, people don't have as much money.
Yeah. So okay. So this is how I look at it. So let's say I make $10,000 a month, right? So when I'm sitting at 32% personal savings rate, I've saved for that month, I've saved $3,200. So that's cash in my bank account, right?
Right.
And then next month I'd be saving $2,800. Next month I'd be saving $2,000. So I built up all that cash over the last two years. That's in my savings account right now, ready to be deployed. Does that make sense?
Yeah.
So all that excess cash that I built up.
That's a rate of savings that we're looking at, not necessarily what's in the account, if that makes sense.
Right.
Yeah, it's not the change in personal savings rate. This is actual rate of savings, right? So if it's saying 32% savings rate, it's saying I've saved, if I make $10,000, I've saved $3,200 that month. Yeah. And so I built up all that excess cash and all that money is sitting in my account right now. So even though the savings rate is down to 6.2, I'm still saving $620 at these rates. So I still have plenty of money in my bank account, if that makes sense, Mark.
So then you're saying that 6.2 going forward is just going to level off?
No, I'm not saying that at all. It could decline. I'm not going to try and predict where it goes. But what I'm saying is there's a enough buffer in my savings account to fight any kind of inflationary pressure in your consumer goods for a period.
Okay.
Yeah, the thing that I think, and I may disagree with everybody, I'll just give you my take on it.
Go for it.
Is I think that the demographics are driving it. I think everything's being driven by demographics, and the demographic that's coming is larger, and the rate of change of that demographic is steeper, like the 1970s. And that demographic rate of change is what's causing the inflation. You can't have inflation if you have nothing to kind of get that money into the system with. And there is no pause in this rate of change in the demographic over the next couple of years. It just continually hits. And it amplifies over the next 2 or 3 years because of that millennial, basically the population coming into home buying years between 30 and 35 years old. That's the demographic I'm talking about at that age group. And they're going to be ramping their spending up at the same time, buying a house, buying couches, having kids, spending on kids, X, Y, Z, whatever they're spending it on. So I think that we are going to have a slowdown just because of the reasons that you're saying, Mark, where people will get squeezed. They're going to deploy money differently. They're going to deploy it more towards housing, more towards things that they need, and all that excess junk, technology, the I'm going to say crypto, whatever it is, they're going to take that money out and deploy it somewhere else, because And what I'm speculating on is that they're going to redeploy it to real estate and commodities, and it will be an inflationary environment because the demographic is driving it. And the reason I don't think we'll have a slowdown anytime soon is because the housing market is really robust right now. And I think the Federal Reserve and the banks are scared of it. They know this demographic's coming. They know that the house prices are rocketing, and they're like, holy crap, we got to slow this thing down. So what you're seeing is they're getting the heck out of bonds. They're like, get me out of here. I'm running out. Get me out of here. We are screwed for the next 3, 4, 5 years. That's why I'm seeing the interest rates increase so dramatically. That's that money rotation. And yeah, they're moving it into the dollar, I think, temporarily. The thing that they're going to have to figure out next is, where do we put it? Some of the money's leaking out already and trying to get there first, which is going into oil and going into all these other areas. But the problem that I have of like a crash type scenario, and why I don't think it's going to happen yet, is in the 70s, you had such really high inventory levels at some point in that market move. So the demographic laid off, so to speak. It was a big surge of demographic, and then the demographic ran out. It's like, crap, there's no one to put these homes into. And we were building a lot of homes. Then we went into a high inventory, and that crashed. That crash is a deflation recession. And if you notice, every time the housing starts crash down, we get these recessions. So a crash in housing starts, recession. Crash in housing starts, recession. We have this one that's an outlier. Crash in housing starts, recession. Crash in housing starts, recession. Crash in housing starts, recession. That's the dark gray lines. Every time we crash in the housing starts, we get these recessions outside of the 2000 recession. And what I'm looking at is I'm looking at the inventory levels of these single family homes and existing condo sales. That's kind of the aggregate, and saying, wait, we're way too low here. We can't have a crash until we get back up above 10. This was the last housing kind of recession area, because the housing starts blew up. Here's your housing starts declining before that 2008 recession. The loaning into the system stopped. It was like, whoa, 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 we have no loans coming into the system. Everything slows down. Your inventories basically go to a level where they replenish their entire inventory, and to levels beyond that, where you could have a housing crash. But we're on the opposite. We're like so far from that, where we have record low inventories of housing and a demographic that's a wall of people all coming through here saying, I want to buy a house. I want to buy a house. And people are saying, look, we got to price these people out. How do we do it? And what's happening is the prices were rocketing. They're rocketing at faster clips here recently. And obviously they're trying to slow this down with interest rate increases. And the bond market's selling off like heck, because it's like, get me out of here. I'm losing money in bonds. So the difficulty I have with most people saying that we're going to have a deflationary recession is there's too many loans going into the system, and we're still ramping up our housing starts. And if you look at where we are with the housing market, this is the housing production has not kept pace with the population growth. We're coming from an underbuilt scenario where we've really haven't built too many homes in relationship to the population. And that's just, you know, some people will say we don't have a structural deficit, that there's homes out in the system, and some people own 2 or 3 or 4 homes. I'm not going to go down that path necessarily. All I'm going to say is we don't have homes in inventory. We've produced less homes over time compared to history. And I don't see necessarily in the bond market positioning for a deflationary crash. So I have to remain long in the commodity inflation trade, because I see no signs of that ending anytime soon. So that's where my head is in the short term to medium term of the next year, 2 years, 3 years, 4 years. I have to see inventories come back. I have to see the interest rates having an impact on the housing market and on the housing starts. I have to see all this data basically round off and start turning around. And I just haven't seen it yet. So that's where my head is at. And I don't know if, I mean, maybe there's other things that you look at that you can, you know, let us know that you look at that may disagree with this.
Well, there's, oh, go ahead. Were you done?
Yeah, I'm good. Yep.
Okay. So there's also people per household. is extended out the most. I don't have the chart with me, but you also have to look at how many, if I don't know if you have that chart, but how many people per house there are, and it's spread out like crazy.
Yeah, the average occupancy of a house, I think, is 2.
Is it
If I-
two?
if- yeah.
Okay. The other thing is where I push back is the interest rate. If wages aren't meeting, and of course, if the personal savings rate, going back real quick, back to Scott's thing, if people have tons of currency that they're just sitting because of the big boom and bust, all that stuff, then why do we have record credit card issuance in March? I mean, it just blew the doors off of people just because normal human behavior is you're not going to charge your credit card. You're going to spend your cash first in your accounts because you don't want to, get the interest payment on your cards. So that'll be the next time you go to credit card issuance. You'll use that next. But then you go, my pushback, Andy, is that personal savings rate's going to keep falling as the Fed pushes those interest rates up by siphoning off the mortgage-backed securities off their with quantitative tightening. And then all of a sudden people are going to turn and go, I'll move in with Susie Snowflake down the street, my friend, because I can't afford this house anymore. And Dandy, I think that's the only thing. I agree with you, your charts, you can't deny the reality of your charts. They're spot on, 100% agree. I just look at the demand side where these people get to a point where they just can't afford it. If their wages go up tenfold, oh, it's a housing boom, boom, boom. But that's where I push back on the demand side.
So, and I'll go strengthen my case. If there's a wall of people that are coming to buy homes and there's a huge shortage of homes, I'm going to say there could be a shortage up to 5 to 10 million homes. What that means is if your inventory is at 500,000, I'll just show you a quick thing here. This is our housing inventory remains far below pre-pandemic levels. This is the housing inventory right here of about between 500,000 and a million. So I'm just make up a number, 700,000 or 650, somewhere of that range. Now, my question just would be, what if we have 5 to 10 times more people that want to buy a house, a single family home or whatever? We have all these people that want to buy, and all you have to absorb a 10 million demand is 600,000 homes. Do you think the median person, the medium income person, could afford a house in that type of environment? And in that environment, how far out of whack are house prices going to have to go in terms of affordability to balance the market out if you have that large imbalance of the demographic?
Sure. And my pushback is they'll do the exact same thing with their behavior that they do with oil prices. When oil prices get out of range, me and Andy work at the same job together. Well, oil prices are way high, so I'm paying higher at the gas pump. So instead of putting, gas in my car, hey, Andy, let's carpool together. So people will start moving in together because they, I'm in the camp of demand destruction.
Agreed. That's exactly what needs to happen. I totally agree with that.
Yep. Yeah. I think we agree on everything. It's just the timing on literally everything. It's just timing. Yeah.
Yep. That's probably the case. I just think that we're going to see a rotation of money. It's going to look ugly in the short term, which is happening right now. Like you're seeing people kind of convert to dollars. It's rotating over. And I didn't know how this was going to work out. I said it on the channel like a year. I said it a couple of times. I was like, when this starts to rotate and the market rolls over, I don't know necessarily what's going to happen to the commodity stocks, because we could get pulled down with it. We could go sideways. We could get delayed. I didn't really know what that was going to look like. And I didn't know how fast this money was going to transfer over either. So I left it open. Like, I don't necessarily know if we're going to pull back or if we're just going to rocket higher. So I'm using this as a buying opportunity because I know that again, my take and my opinion, don't use it as financial advice, but my look at it is the driver of the inflation is still there, the demographic. And it could slow down, but I don't think it'll stop because we haven't seen the slowdown yet in the numbers. And this takes a while. This is like turning the the Titanic or something. And you know how fast that turns, not very fast. It hit an iceberg.
Right.
So I don't think we can turn it very quickly. And the demographic is still adding that pressure. And it's like, I can't position myself if the pressure is still there and it's still, you know, the tailwinds are still behind us, position in a way that is against that. So I use it as a buying opportunity on pullbacks because I know that at least in my opinion, I think that the pressures are still there and they're still driving that inflation. And I think the Federal Reserve is basically screwed. Like they are so screwed because they're looking at it and they're saying, we don't want this inflation. How do we get rid of it? Even though they wanted it in the beginning. Now they've got it. It's too big. And they're like, how do we slow this thing down? Holy crap. So now they're raising rates or letting the rates go up at very quick pace, at a quick pace. They're just like, screw it, let it go. But the problem is they're going to get to a spot where it does start to impact the debt repayments, the interest rate payments and all this stuff. It's going to impact all of that. And then they're going to have to print more money to cover that. And now we're entering a scenario where money's just flooding into the system from all facets. You got the Fed printing money to cover interest rates. The Fed's printing money to prop up whatever they're going to try to prop up. You've got the housing market running on full cylinder, you know, all cylinders with money just flooding into the system. And now you're left with a bunch of inflation and everyone's going, crap. So then I looked at the bond market and said, what are the banks doing? How are they positioning for this? And they're like, see ya, I'm out of here. So I'm like, oh crap, I'm getting afraid because they're leaving the whole bond market. They're just exiting in mass. That's why we're seeing a vertical 10-year yield. And I'm positioning like, I got a position in precious metals. I'm positioning in energy and all these other commodities. And when I look at it, it's not necessarily like I have to win my money today. Like I don't need to worry. I'm not worrying about making money this month or 2 months or 3 months. I am positioning like the banks are. It's like, get me out of here. I'm positioning for an inflationary front. And I think that's what they're doing. Do you see anything out like in the system that you see where people are positioning for a deflation or the type of scenario that you're kind of seeing? Like, what are you gauging? I mean, you said personal savings rate, but is there anything else that you're looking at where you're just like, man, you're seeing people position a certain way in the market? Because I'm using the market as my data. That's how I'm using my data. I'm not trying to make any projections. I'm saying housing market inventories, days on the market, which is moving faster, and prices they're up 14.7% week ending April 30th, 2022. And the active listings are still low on an already super low number. They were down 3%. So I'm just looking at this going, nothing's slowing down yet. Like the momentum hasn't shifted to the other direction. Is there anything that you're looking at where the momentum is shifting?
Yeah. So for me, the two things, the momentum has shifted as in what the Fed is doing. And that's big to me. Okay. And that's why for me, I've been very successful over time because I do pretty much exactly the opposite of everybody else. When all of a sudden the stocks are crashing, like big time crashing, I'm buying in. Good example would be April of 2020, right? March of 2020 was pretty much the bottom. You can never guess the bottom, but I started buying April of 2020. So then all of a sudden we have a whipsaw back up. I get out of there. I'm not a trends guy. I more or less, I want to be where everyone's not. Good example would be uranium stocks. Mm-hmm. I bought a long time ago, right? When nobody wanted them, right? Same thing, bonds. Nobody wants bonds right now, right? To me, that's a perfect position to be in because everyone's getting rid of them. I do the exact opposite. And then all of a sudden people pile into it and I get rid of it. Same thing with stocks. Those are my gauges. When Andy, when oil prices goes from $60, then 80 to 100, 110, 120, that is my perfect sign to get out of there, to short it, because that's not over time. It's not sustainable. Everybody's piling into it. When the herd wants to go in, I'm the other way. And that's why I'm a humble guy. I've done pretty well for myself over time. So that would be my gauging.
Yeah, let me
sorry, Andy, just Just before we move on, can I just share with Mark, because you did mention the credit cards, can I just show you my chart? Just around credit cards.
Yeah, of course.
Yeah, so this is basically what you're talking about here, which is we've had a significant drop in consumer loans around COVID, because obviously the savings rate went up, and now we're seeing an increase in consumer loans. That's what you're saying. But if I just look at this chart, when it's growing, when the consumer loans are growing, and we've just started growing, isn't it bullish normally?
But that would make my exact point. When it's extremely bullish, that's the time to get out. When everything's euphoric, when you're, Scott, a good example. Uranium's at $200 a pound. Everyone's going crazy. Everyone's going mad. Scott, what's your behavior?
I will sell,
right?
but we're nowhere near that point.
No, I'm just saying, that's the exact same thing.
Okay. Let me give you another. Sorry, Mark. Let me give you another perspective of consumer loans, because I think it's really important that the viewers understand this. Because what I've done here is I've just done consumer loans, which is basically this, right? Oh, sorry. Consumer loans, that divided by GDP. Right? So it gives you a true picture of how much the consumer loans are worth in relation to GDP. And what we see here is, yes, we might have had a little bit of a spike, but we're sitting at like all-time lows compared to GDP. I mean, if you compare it to the last couple of years, right? So we've got a lot of room for growth in consumer loans, which is inflationary once again.
I would agree if interest rates start falling, because as I agree before, as prices, if you get look at a mortgage payment on $300,000 at 3% to 6%.
Yeah, it's not as affordable. Agreed.
It's not as affordable. So then that eats away at everyone's pocket. So that's but well, it's an thing, because
it depends.
It's not. Go ahead, Andy.
Right? Go ahead. Well, it depends, because remember, we're already pricing a whole bunch of people out of the market because we don't have enough homes for the people who are already this big demographic coming through. We don't have enough homes. So what you said, you could look at this as a positive. You said that people were going to double up and share a house. Maybe their disposable income actually goes up doing that.
Agreed. 100%.
So what if a whole bunch of people start doubling up and tripling up in homes, and their disposable income actually goes up?
Then it would be a lag time, because they would have to get their savings up as they stay together and then buy those the depleted. You know what I mean?
Yeah, I'm just saying short term or medium term, if we put two families in a house, which people are doing, that they would have actually more disposable income per month for those families that decided to do that.
Agreed.
That's all I'm saying.
Agreed. Yeah.
I also have I've got some data too. Here's another one. This is the energy burden. So this is the household energy burden has fallen for decades. So we are coming from very, very low levels of the energy burden. And now I'm not saying that this coming up and the rate it's coming up is necessarily good, because obviously it's going to cause havoc or it's going to have an impact on disposable income. I completely agree with that. But we have a long way to run higher to get back to levels like the 1980s, where people were spending 5 to 6% of their entire share of personal consumption expenditure on energy. We are still really, really low, and about half that. So to get to psychological levels, to get to ratios and all that data, to get to a point where I think things start to break, I think oil could double from where we are today, or maybe triple, to get to a level where people are like, oh my God, this is it. It's done. And I'm not saying that necessarily, a double or a triple is necessarily going to happen. What I am saying is that there's room to the upside for the prices to still extend further. And I think that the driver of that, the driver of that inflation is still there through the housing market, the money into the system. And remember, it's a percentage of personal consumption. So wages will also go up during this time as well. So it's two moving targets going up.
So Andy, would you say that you could see oil prices going to, right now is obviously at 109 or whatever WTI, you could see it going to 150 to 200 before you think it's going to be in bubble territory?
Well, it depends, because what people are doing is they're running away from inflation, and money is going into oil for multiple reasons. They're going into the stocks to have inflation protection. Then you're going to go into oil because there's supply demand problems. So the numerator, which is the supply and demand of oil, and then the denominator of dollars, they're both getting hit at the same time. So when you have that type of scenario, I think oil could go to explosive heights in the next however long. It could be 2 years, 3 years, 4 years. It depends how long that demographic can come into the homes, the housing starts. As long as loans are coming into the system and pumping it full of money, the denominator, which is the value of the dollar, will continue to go down. And I know that they use DXY, which is a relative indicator against other currencies. Our dollar could go down against other currencies depending on how strong those other currencies are. But remember, when there's fear in the market, people are going to prefer the dollar, which is the reserve currency. They're going to run to the dollar first. So if there's fear in the market, then, which there is right now, because the market is coming down and people fear that, they get afraid. The thing that's really weird is, and this is what I think is driving it, I think interest rates are driving the moves lower in technology stocks and the overall stock market, like the S&P 500. The reason I think that is because people are running away from bonds. If there was a true recession, like deflationary recession, I would see people running to bonds in mass if they thought that the entire market was going to crash. But I think the interest rates are driving the rotation of money out of stocks and bonds into the dollar intermediate, in the intermediate term or short term, and then that's going to go somewhere else eventually. That's the way that I see it in the data that I see in the markets.
Yeah. So can I ask you guys? I got a couple of questions for you.
Mm-hmm.
Okay. So what do you think the DXY? I believe it was April 12th. The DXY went over 100. What do you guys feel that does? The DXY over 100 does to the global economy?
Do you want to go, or do you want me to go? He's on mute.
You can go. You can go. It's all good.
Yeah. So I don't think the strength of the dollar, in my opinion, is really going to do much of anything, because it's a relative strength. We have inflation across the globe in all of these different countries. And that inflation, I think, will cause people to behave differently. So even though the dollar is strong, it's not absolutely strong. It is relatively strong amongst an entire group of weakness. So everyone in the world is going to, in my opinion, is going to change their viewpoints when this inflation is persistent. And it's persistent long enough where people are like, screw it, I'm throwing in the towel. I'm just going to get out of bonds when they're seeing losses in their bonds. They're going to get out of stocks when they see losses in their stocks, and they're going to have to rotate into something else. And that money eventually will divert towards real things. So when I mean by divert, we came from a world of excesses. Those excesses were found in commodities and real estate and all this other stuff. Everything was cheap. Energy was cheap. Everything was cheap. We were living the high life. So they got bored and they started speculating on cryptocurrencies and NFTs and fictitious real estate property that no one owns, but somebody owns. And I don't understand the whole dang thing. But that is a signal that you are in a euphoria of a bubble top in technology, in a bubble top of speculating on intangibles, non-tangible items. What I think is happening is we're going to see this grand rotation. It's going to be insane, based off of the demographic coming in, based off of the inflation, and then the realization of everybody, where institutional investors, retail investors, just the whole psychology of people will change, and then money's just going to divert to real things, which is commodities and precious metals and intangible items. And that will happen for a while, maybe 5 to 10 years. And then when that's done, the demographic runs out. We see a decline in demographics. And I don't necessarily know how it's going to play, because your liquidity from the system kind of dries up from the demographic in terms of the housing market. But the commodity shortages persist in a lot of these different commodities. So that's where the real work is going to happen. It's going to be out 5-10 years, because your denominator of the dollar could strengthen in absolute terms, or you enter I'll call it a very, it'll still weaken, but it'll be a lot less weakened. So it'll be a disinflationary period for a good period, but the commodities will still all be short. That's what I think will happen. Not all of them, but a lot of them. Like uranium could still have shortages. Copper could have shortages out in the 2030s. Nickel, cobalt, like all these different ones. If we decide to go the electric vehicle route, renewable route, I still think there may be some lingering shortages out there in commodities.
What's Scott got for that? Is he on the same camp with that?
Yes, I am. Although just with the commodities, I think it could be resolved by high prices. So once we see ridiculous prices, might see a massive production, all the miners come into production, which might resolve that supply demand issue. But Mark, I just wanted to share with you also this chart, which is basically oil at the top, and you've got Fed funds rate at the bottom. So what you see every single time that they started raising rates, the oil prices go up, even in a bear market. So this is the start of the rate hike, oil price shot up. This is another start of rate hike, oil price shot up with the rate hike. This is a bear market, right, in oil. You've had start of interest rate rise here, it went up. Start of interest rate, this flattened here in bear market. Another start of interest rate rise, oil went up. Start of rate hike, oil went up. Start of rate hike, well, oil went up. We're just starting rate hike. So this is basically telling you rotation is coming, because when interest rates start rising, your bond prices are falling and people are running away from bonds, which means they've got to find another place to go, which is oil. And I don't know if you, yeah, sorry, do you want to make a comment?
Yeah, this is a perfect chart for my point. This is exactly great chart. I love this one. This proves my point to a T. Okay, so if you go back to Scott, if you go back to 1980 right there, where the Fed funds rates was real high, right?
Yep.
Then every single time there's the yellow bar, which is recession, right?
It's just the start of the rate hike. It's not recession.
Yeah. Okay. So, but every single time they try to hike interest rates, right, it gets lower and lower and lower, right? So now if you go to 2018 right there, they got to what, 2.45, right?
Yeah.
So correct me if I'm wrong, but we're at 0.75. If the Fed does what they say they're going to do, we're at 1.75. We're almost, what do you guys see as the Fed funds rate going to before they reverse course? That would be the first question.
So I can throw something in there from 1980 to 2019. And I don't know if not a lot of people know this. The demographic of Generation X was declining that entire time. So the demographic, in my opinion, drove those interest rates lower. And what's coming is a larger demographic, and it's the rate of change is great. So I don't know if they can stop the market where they want to stop it. They're going to have to use copious amounts of money. I mean, massive amounts. So what's happening is you've got this large demographic coming in, which is far larger than the Gen X demographic. The Gen X just slowly went down, and then all of a sudden you get this big spike of the millennials coming, and the rate of change is really, really big. So that's why we're seeing the housing market just blow up, because we've got way too many people wanting to buy a house and not nearly enough homes. We are way, way, way short. So I think that the interest rates chase the inflation created by the demographic. That's my take. So what I am saying, and I'll make this statement here. What I am saying is that demographics, as they go up, as they expand and contract through the spending years and home buying years of that demographic, actually prices the assets of everything through interest rates. That's my theory, basically, or the thesis of the channel.
So Andy, question. So
Mhm.
as demographics gets thrown in, like you're saying, then they'll be able to get that Fed's funds rates up to 3, 4, 5%. You're saying.
It's
Okay.
possible.
And see, that's where you and me, that's where, okay. And that's where we would differ.
Mhm.
Because I don't think that they'll get to 175. And that the part I do agree with you on is they'll get to one. My prediction is 1.5 to 2 at the utmost. And then, like you said, they're going to have to throw so much money at the problem because they're going to have big problems on their hands. And then it's game on where commodities. You know, I do have another question for you.
Mhm.
For both you guys. I know you don't know, we can't know this, but what do you guys have? Because I'm the biggest bull on uranium stocks. Not right now in 2023. I think the fuel buyers are going to come in 2023 and it's going to be game on for those stocks. You're going to see explosive moves like crazy. What price per pound do you guys, I know it's an estimate, but what do you guys think? I have 150 a pound. And I'm trying to be standard, you know what I mean? Because I know the supply deficit. And so what do you guys think?
You go first, Scott, and then I'll go last because mine will be ludicrous.
Over 1,000.
You're going to 1,000?
Scott, can you repeat that again?
I think minimum.
I hear
I
1,000.
think minimum 350. I think minimum 350.
So
Okay.
he says minimum 350 is what Scott says.
Okay. Scott, can you elaborate how you get to 350? Please.
All right, Andy, you start talking. I'm just going to pull up my presentation.
You don't have to go through the whole thing, but I'm just saying,
So-
obviously there's going to be a bidding war for the uranium that we don't have. There's not enough.
I think we're going to get close to the price of oil, and I think oil is going to go up pretty high. So I think oil could go between $250 and $500 a barrel. And that's with a heavy inflationary environment coming behind us. And so the dollar will be worth a lot less. And that is what I consider to be a solid bet with a blow off top. It won't be there forever. It'll only be there temporarily.
And that you said that's for oil. You're saying oil.
Oil
Like
and I think uranium will be somewhere around that same price.
Okay.
So it'll be
Right, so what
250 to
Andy's talking
500.
about is this. What Andy's talking about is this. I did a presentation on uranium with Andy, if you want to watch it, Mark. But so here I do a Dow Jones to oil ratio. And so we've got the energy crisis of the 1920s. And so Dow Jones to oil met at 20 to 1, right? We've had another energy crisis back in the 1970s, as you know, and we've also come back down to 20 to 1. So what we're saying is we probably have an energy crisis right now. And if it does, and if Dow Jones stayed at its current level of around 33,000, we're going to get to 1,650 per barrel. What's interesting here is that during the 1970s and 2000s, oil per barrel met uranium per pound at the same price. So back in 1970, we had peak uranium price of $40 per pound and peak oil price per barrel of $40 per pound. And in 2000s, we had peak uranium price per pound of $140 and peak oil price per barrel of 147. So if uranium meets oil 1-to-1 this cycle, we could see 1,650 per pound of uranium. That's my case.
That's Dow Jones, right? That's if the Dow Jones remains where it's at. I think it'll go down. I think the Dow Jones will go down quite a bit.
Probably go down. Yeah, I would say so.
But I think the Dow Jones could get cut in half easily, and that price could get at least cut in half. Is my guess. So I mean, $800 a barrel. It could.
Yeah. And this is just gold to Dow, using gold to uranium ratios. But you can probably go back and watch the video that I did with Andy on uranium if you want.
Yeah, absolutely.
And what we're doing is we're not trying to sound ludicrous here. And I know that some of these numbers can sound ludicrous, What we're doing is we're looking at history and trying to say, okay, if the ratio were to repeat itself at a psychological threshold again, because I call that the psychological thresholds that either the participants can take or that the economy can take, either one. If it were to repeat, what would the number be? And everyone was going to tell you, no, 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 no. But if you were to bring those numbers to the beginning of the bull market and told these people, look, oil is going to at least $40 a barrel, they'll be like, it's like $1 right now. What are you kidding me? It's not going to go up 40 times, but that's what happened. So I think that things could go probably crazier than what most people think. And it highly depends on the market conditions and how short we get. There is a couple of people that were looking at oil this year. We're talking about this year, where they were like 5 to 10% demand destruction is going to be needed. And I'm like, 5 to 10%. Do you know how big that is? They're thinking, well, oil is going at least 250, 300. And I'm like, maybe, I don't know. That just seems ridiculous from where we are today, but it just broke out oil just broke out of its pattern here recently. And remember, interest rates and oil are like basically married together. So if we see oil just take off, which is going to impact your consumer price index, which is the inflation numbers that most people use, and the money's in the system and it starts rotating over and it starts rotating into oil, I mean, this is going to be a lot of fuel. This is going to be a lot of fuel for the move higher. And I don't know where it's going to end up. I don't want people quoting me and saying that I'm predicting this, but I just know that it's going to go higher. That's my take. The eventual price.
And Mark, and this is what Andy's talking about, Mark. So back in the 1970s, obviously you've had massive rising rates. This is oil to Dow Jones ratio. Oil just shot up. so towards the end of the first rate hike, oil just shot up. So this could be what you see, like in relation to Dow Jones. You've got massive amount of money like just rotating out of general equities and bonds and just going all in commodities. This is the type of move that we can see. And go ahead.
The one thing I wanted to add, though, if oil does get to those levels, your interest rates are going to go skyrocketing.
Yep.
And what that means 100%. Is people are going to be running for bonds inflation. Like no other.
Yep, to fight off inflation.
Sure.
And it's the cycle that we keep talking about, Andy, right? So, commodity prices go up and then you've got to tackle inflation even more, which means you've got to drive up interest rates even more and so on. So another reason why I think we can see a far higher interest rate this time around, Mark, is because of this. So this is just inflation minus Fed funds rate, right? So the top chart here. So what you see here is back in the 1970s, your Fed funds rate exactly followed your rate of inflation. This is the rate of inflation, right? So when the inflation rate was sitting at 12.24, Fed had to raise their interest rate to 12.8, right? This time around, inflation rate is sitting at 8.5%. And as you know, it's probably way understated. What this means is Fed funds rate, if they want to keep to their mandate of price stability, then they need to be raising this up to around here, 8.5. So this is telling me that they are way behind the curve and they probably have a lot of catching up to do. So you know what happens when they lag behind? They probably need to shoot above it to catch the inflation fire. Does that make sense?
I don't know if they can.
They're
screwed. Like I said, they're screwed.
Yeah,
no way.
I agree if the inflation keeps going short term, that obviously the rates would go up, but there's too much debt in the system that they can't. You get right now, you get 7-8% on the Fed's funds rate, you're blowing up the whole system. And that's why if they really wanted to fight inflation, why didn't they just go, oh, not a quarter point, because you really got real negative interest rates. Why don't you just go to 10 right now? It'll blow up the whole thing.
We agree with you. And that's
which is why they're going to stay behind the curve.
Mm-hmm. And they're not facing a problem. They're facing a predicament at this point. They have to handle outcomes now. This isn't like they can solve things. Before they could kind of like, we'll raise it, we'll bring it back down, no big deal, demographics is good, whatever. Now I don't know how they're going to stop this. And that's why I'm positioning for a certain way that I am, because it's like, I don't think they can stop this. I'd rather be in this stuff and sitting and riding through the volatility than be sitting out of it in cash while everyone else is running away from all these other assets like bonds and stocks. And it's just a temporary home, cash, I think, at this time right now. But I think eventually it'll rotate over for a good long period.
For me, I 100% agree with you, because it's a musical chair game, as they're kicking a Ponzi scheme down. In my opinion, they're kicking this Ponzi scheme down the road to prevent our hardship. But in turn, you're creating, by doing that, the printing of the more money in the debt, you're creating unintended consequences that will, and to me, we've had 30 or 40 years, you could say, of no free markets. And eventually, if you look at history, the free markets wake up from hibernation and they take over. And that's why and I was going to ask you guys on what you guys think the end game is, but the last question I had was, what's the end game? And my end game is eventually the Fed, it'll be such a bad of a crisis, the Fed will become legal tender to the Treasury, because they won't have a choice. And then it's game on, where you're going to see, to me, the end game's hyperinflation 3 years after they become legal tender. And you see that in all of these hyperinflations, when all of a sudden the Fed basically, because now obviously the Fed can't print money. You know what I mean? So they got to go through the laws. But in a crisis, to me, my reasoning is they won't care about the laws, because they have a massive crisis they got to prevent. Just my opinion.
Yeah, all I know is that we'll see very high rates of inflation first, and then they'll progressively get worse. Then I can jump in the hyperinflation camp. So my whole take is, or what I try to do is, I look at data in the market. I try to identify where the trends and inflection points are. Once you can identify the trends, then you monitor those trends. Like, for instance, the real estate market hasn't yet turned because the momentum, the inventory is low, the days on the market are getting shorter, and the prices continue to increase. I just look to see, hey, look, is this still intact? Yes. Is the interest rate still intact? Yes. Are the trends still intact? If the answer is yes, I don't do anything. I just accumulate and stay the course until those trends change. I still think that the trends won't change for another couple of years, but that's me. I don't know.
I love it. And then Scott, what do you have for the end game?
I don't know. I don't want to predict anything. I think I'll just go with the flow. So I'm just going to be observing data. But yeah, I mean, I'm not going to rule out the hyperinflationary possibility, but yeah, I'll just go with the flow.
Okay. Awesome.
Yeah,
Mark, I just had a question. Sorry, go ahead.
No, I was going to ask if you had any other questions.
No, I just had a question for you, Mark. So this is just in relation to your post here. And it says, now I'm protected. So we just wanted to understand, I guess, your position right now. So you said you're protected, but you have exposure, right? So just wanted to understand that.
Okay, yeah. So what that is I still hold, because I believe uranium stocks are good asymmetry. Okay.
Yep.
So I still hold some uranium stocks. Okay. Of my 94%. Okay. So in turn, it just depends on how much money I would make, because if I'm right, I'm going to make a ton. Okay. But in turn, if markets go like you say you guys are going to go, my uranium stocks are going to go ballistic, and then I make money on that end. So I'm protected on both sides, because I believe the uranium stocks, in my opinion, are the best asymmetrical bet for the next 10 years.
So your position 6% in uranium, is that what you're saying?
6% of my holdings, but I also see them going ballistic. That'll make up for the inflation that would see, because I'm protected the other way.
Okay, is in through like options and stuff?
Well, I have a couple of shorts on commodities. Okay.
Yeah.
Also into cash. So I would be losing money. Think about, I'm losing money on a 7-8% inflation rate on my cash in there, but now I'm 6% in the uranium, but they're 10xing.
Mhm.
because there's massive asymmetry there. So
Yeah.
in my scenario, of course, I make a lot of money. In your scenario, I make some money, but not as much as obviously you guys would be the way you're positioned.
Yeah. Yeah.
I'm positioned in like uranium, oil, some precious metals, royalty companies, and I'm like unleveraged. It's mainly stock. I have some warrants. I don't really have a lot of, I have like zero options. I don't really push the leverage button. It's like sitting them and I'm just going to ride it. That's my strategy. So
my other question is, Mark, let's say it doesn't play out the way you think it would, right? And you're not positioned in uranium. Well, you're positioned only 6% of your total portfolio in uranium. At what point do you FOMO back in? Like, because that's the biggest thing for me. Because for me, the reason why I sit tight is because I don't want to be FOMOing in, and because that's what I did in the last commodity cycle. Because once this thing gets moving, it starts going parabolic, right? So at which point would you say you would get back in? Like, let's say it doesn't go according to your plan, and let's say it just starts shooting up, right? Because it's in a clear uptrend so far. Let's say it starts shooting up. Do you re-enter the trade or do you just stay out?
To me, I just stay out because
You stay out and miss the whole bull run?
Yes.
Yeah. Okay.
Yeah. So, well, it's,
Okay.
I'm very well off for me. So I don't need to take that much risk. You
Yep.
see what I'm saying? Which if you guys are correct, I'm not going to make as much money, of course. But then
Yep.
in turn, I will make some money, just not as much as you guys would at the position you're in.
Okay.
So it's a win-win for me. It just depends on how much I'm going to win, in my opinion.
Okay. How about your short positions? At what point do you get out of your shorts? So let's say with you, so for example, right?
Mhm.
Do you have any specific commodities that you're shorting now? Is it oil or
One would be nat gas.
natural gas? You're shorting natural gas?
Yep.
when did you put
Okay.
that on?
What's that?
When did you put that short on?
Not too long ago.
Because that's been going up
Okay,
quite substantially recently.
Yeah, I think
Yeah.
I think at around when it was around 6, I started about 6. I started shorting it.
Okay.
It's at 8:50,
So-
right? Or 8 o'clock. It's at 8.
It's at 8. It's at 8. Yep. But see, of
So
course, it's
at which
the same
point
thing.
would you get out of your shorts? So let's say it starts going against you, and let's say it just skyrockets up to these levels, because this is the next resistance level that I see. Like, at which point would you get out?
Well, that's the thing. If it goes up to 14, I double down. I'll triple down, because look what the charts show. What happens next?
Well,
But if you measure this in gold, it can go a lot higher.
yeah, it can go way higher.
Because that only shows you
Sure,
a previous
sure.
high. So if you measure it in gold, like, it can go, this thing can absolutely skyrocket.
Sure. But then
It can
also
go up another 820% measured in gold.
Sure. But also gold could obviously do the reverse too. I don't think it's going to.
Yeah.
But that's why it goes around what I'm saying is short term. If I have disinflation, interest rates start coming back down, then my plays would work.
If
Yeah.
that scenario were
Yeah.
to happen, yes. If
Yeah, right.
But I mean,
Exactly.
the way that I look at natural gas, though, I mean, you're playing with fire here, right? Like, natural gas is one of the most volatile commodities there is. Uranium and natural gas are like, they're like paired up in terms of their volatility. And natural gas on a worldwide basis, all of the prices are the highest outside of the United States. So the United States is the laggard in this scenario. And the more we export liquefied natural gas, the higher the natural gas prices are going to get in America. So the more that they build these liquefied natural gas terminals, and the more that they can export, the more that the international pricing will converge with America. At least that's the way that I see it. I mean, you could see natural gas prices at $25 a million cubic feet
Sure.
based off of that. And hopefully, I mean, I'm positioned for natural gas to go higher. That's me. But
Right.
I mean, if I were to pick a short, if I were to pick any short, I'd pick Bitcoin right now. That's what I would short.
Right.
Yeah.
So I would
so
short
this is
Bitcoin.
natural
I would
gas
agree with that.
Yeah.
I would agree with that.
This is natural gas
Bitcoin
to
or
Dow
tech.
Jones ratio. It looks like it's just breaking out. So broke out, back test, and it's breaking out again. So
Right.
Yeah, it looks insane. I think
is it a protected? I mean, is there a downside limit to your short? As in, like, are you?
No, it's an ETF short.
Okay, so your maximum loss is it goes to 0.
Sure. Yeah.
Yeah.
So
Yeah, I was like, if you have like a naked short or something like in options, I'm like, oh my God.
no. So, but then it would go with what I'm saying, as in, if they get the Fed funds rates to 1.5, 1.75, and then have to reverse course, that'll be, I win on that.
Well, maybe not.
Yeah.
Well, because they're going to lower the interest rates because it's bad times.
Well, it depends. If they lower the interest
Depends.
rates and it's inflationary and they're doing it because they can't afford the payments on the interest rates, like they do this huge, massive QE, then natural gas could go ballistic. But you're saying that there's going to be something in the system to slow the system down or the inflation down, where I mean, in that scenario, you might be right.
Yeah,
But you
that's
better-
what I have.
Yeah, but if they
That's
hit
what I-
1.5 and it breaks something in the system, but it doesn't break the inflation on the other side, what if this inflation keeps coming in the system and they hold rates low? Like that will be,
Yep.
It'll be explosive. I mean, it'll be
Yep.
like, boom. I mean, it could go to like 100
Sure.
in a short-term spike because everyone's like scared and they're rolling, because if once people figure out that this inflation isn't transitory, or if they change psychologically, and if the institutional investors start changing too, I mean, then the money just starts rotating and it's game on. And then the retail sector, you know how they FOMO into stuff. If they see the price movements, they'll just pop all, pile in as well. So I don't know. I don't know. My opinion, you're playing with fire, but that's me. I mean,
That's
if anything, if you thought that scenario, I would choose something that, I mean, what I would do when the rates were coming down a little bit, what was his name? There was a hedge fund manager, Steve Druckenmiller, I think, played a pretty good one. He piled into bonds, and then he's like, well, if nothing happens, bonds don't go anywhere. But if we have a crash, he did it before the COVID crash, that came and he made a bunch of money on that crash in interest rates. But now you want something where your risk is like really limited and your rewards are really, really big. So that's the reason I would never short Bitcoin. Literally, I would never short it, because you could have a loss that's absolutely massive. So I always look for like huge symmetry, and like natural gas at the bottom, there wasn't much downside because it was basically exhausted at $2 and something cents a million cubic feet. Almost, it was too flat even. And I think it even went below maybe 2. And I was like, there's nothing, like, where's the downside here? Like, we are just scraping along the bottom below all the cost of the most of the producers. So I saw that as the symmetry there. Now, I mean, we're like mid-stride cheetah style going up, and I'm like, man, you're gonna like be careful. Just be careful.
Right. Sure. Well, that's why, Andy, that's of the 6%. You know what I mean?
Yeah.
Yeah. So it's, it's not like a huge amount of leverage into that. So
Yeah, everything I do is unleveraged. I'm just sitting accumulating assets and riding it where I think it's cheap, sitting on top of patterns and stuff. Yep.
And nat gas at 2.5, to me, that's a steal buy. You know what I mean?
Oh yeah.
You know what I mean?
Oh,
It's
yeah.
like the same thing as when silver was at 13, 14. I'm buying a ton.
Well, what do you think's a good buy right now? Besides,
what's it at
besides
20?
shorting,
What's it at 22 right now?
what is? The-
Silver
Silver.
per
Oh,
ounce?
silver? Yeah, it's something like that. 2250 or
Yep.
something, 22 something.
I would say for the physical, 19 in the bust. The mini bust.
Yeah, well, the problem with physical is it doesn't really go down. The premiums just keep going up. So like the price
Right.
is flat.
right,
Yeah.
right,
The
right.
physical metals.
But see,
Mhm.
that's why to me, if we have the bust, I would rather do the leveraged stock. If prices silver goes down to, let's say 16, 17, I would rather leverage up in the small cap stocks, maybe mid cap, mainly small cap, and then ride the wave and then transfer that currency over to the physical because I have the hyperinflation as the end game. Because
Okay.
I'm not going to want to hold dollars in hyperinflation, no matter what.
Here's another question I have for you. In that scenario, let's say you make a bunch of money in the silver juniors or whatever it is, and you go to transfer over to the physical and the physical doesn't exist anymore. Like it's the premiums just go berserk.
Yeah. So then my scenario is I go buy anything that you can touch. Because Andy,
Yep.
it's you know what I mean? Anything that you can touch in hyperinflation goes through the roof relative to the currencies because the currencies are plummeting. The stuff isn't changing, the currency just plummeting in value.
Agreed.
So I would just transfer that over and buy anything that I can touch. That obviously is valuable.
Well, I'm gonna buy Scott over there.
That's awesome.
I just messing. So anything else that anybody would like to share?
No, it's been good. I appreciate you having me on, Andy and Scott. You guys have been awesome. I love the charts, and I have one request for Andy, if possible.
Sure.
Can you do more of those uranium at 100 to 200 a pound? Because those are awesome charts. I love those charts.
Yeah.
The-
Are you talking? Are you talking about the ratio charts that I do, or?
Yeah, like you did I remember a video a while ago. You did Bannerman at like 500 a pound. If you did Bannerman at like 200 a pound or Deep Yellow at like 150 a pound, those are my favorite videos.
Oh, so the projections. So if the physical price of uranium were to go to some level, and
Right.
I was projecting if the returns on some of these companies, where if they were bought out at a 10% price of whatever that uranium price would be, that roughly the market cap would be here and the gain would be XYZ, right?
Right. Yeah. The one, and then you did pounds in the ground.
Yep. The enterprise value to pounds that they have. Yep.
Yeah. Yep. Yeah.
Yep.
So I thought those are my favorite. When Bannerman's one of my top uranium stocks, I love Forces, Bannerman, Anfield, Deep Yellow. I can't think of any of the other ones right now. Those are my top ones. So.
Global Atomic.
Yeah, that's a good one too. I wasn't positioned into that one, but I was deep into. I love Bannerman because they have so many pounds in the ground, and I love Brandon Monroe.
Yeah.
So
we love him too.
We do.
Yeah. So, well, that's
All
all
right.
I've got, guys. Thanks for coming on, Mark. I really appreciate it. People can reach you. I think your Twitter name is Mark McGuire, and we're not talking about the hitting the home runs out, but that's your Twitter handle and your real name. And then, thanks again, Scott, for coming on. I appreciate it. So thanks for both of you coming on and having opinions and sharing those opinions. So I appreciate it.
all right, thanks, Andy.
Awesome.
Yep.
Thanks, Andy. Thanks, Mark.